Nigerian Treasury Bills secondary market reversed its bullish trend due to persistent supply on long-dated maturities. So what level of activity should investors expect at the NT Bills markets this year? Chuka Nwachukwu, the head of bonds trading at UBA, joins us now to discuss this. Chuka, it's a pleasure to have you and Happy New Year to you. So my first question obviously will be your thoughts on the direction of yields. So just to confirm that we do have a consensus here, most people I have been speaking to suggest that they are certainly expecting yields to rise at the latest by the end of the second quarter. What is your expectation?
Yeah, I share the same optimism. Yield will go up within this first quarter and second quarter. At most, latest first quarter. The first few weeks of the second quarter. So we expect that yield will go up. The reason not far-fetched, government is looking to borrow heavily. Next year is the election year, and so this year a lot of activity will be happening. We have a deficit, a budget of well over 6 trillion, and so now government has had most of the borrowing last year from both local and international market. This year we expect that government will lean more on the local market, and so with that we expect that yield will go up.
All right. So let's talk a bit about the borrowing plan of the government, because as you know, we continue to see this expansion of the deficit, and many people that I have spoken to suggest that a lot of borrowing will have to be local this time around. So what, in your view, are the implications of that in terms of how the government is likely to allocate between treasury bills and bonds?
Okay, well, like you said, the government will borrow heavily on the local market. So the implication is that government will obviously make use attractive. And so we hope to see yield level between 13.5 and 14.5, at the least. So, on the bond side, of course, most of this borrowing will probably come from the bond side. And then we see the middle end of the curve to the longer end of the curve, going as high as, say, 14.5, and so this will bring in a lot of attraction into the bond section of the market. And then, of course, also on the treasury bill side, yesterday there was an OMO auction, and then the shorter end came out at 7%, and the longer end came out at 10.1. Of course, they maintained. So we see this pattern, continuing to the rest of the year, especially on the NTB side.
All right. Let's shift our focus now to the forex markets. We did see, of course, a lot of volatility last year. Do you expect more calm this year? Do you think that given the borrowing we've seen to show up reserves, that we're in a better place, and even if we do see volatility, it certainly won't be as much as last year?
Yes, because one, we should hope that the oil price continue to rise, is above $80 per barrel. And then, of course, and also, if you look at some of the policies that the government put in place, they are projecting of FDI increment within the first 3 to 5 years of about 233%. So if you take that based on their consideration and their projection, you see that systematically they are trying to see how they can rely more on local production, the agricultural sector, which the president talked about during his broadcast 2 days ago. But again, on that other side too, there's also a bit of challenge of security. So if you want to, increase local production, using agriculture, then they have to tackle the issue of insecurity. I'm sure that's what they're working on. And so we expect to see, this year a deliberate, policy, in order for us to rely heavily on, not to rely heavily on foreign importation, to reduce the pressure on the FX side. And then, of course, the government is also looking at trying to, remove the fuel subsidy. Now, when that is done, it will give that extra dollar that the government will be, we use to engineer other sectors of the economy, and then, of course, boost our foreign reserve.
All right. A quick thought on foreign investor interest, and I want to hear more about that. You mentioned that you expect yields to rise. We know that yields obviously attract investors, but we also have to balance that with the fact that there is heightened political risk because of the elections. Do you think that we could see some traction in the efforts to draw some foreign portfolio investors this way?
Yeah, over the years, especially a pre-election year, we expect that foreign investors, of course, will there will be a little bit of a capital flight, yeah, because of the uncertainty of the election. But again, if you notice, between 2014 and then going into 2015 election, there wasn't there was a little bit of a capital flight, but then you know, it wasn't as much as people expected, because systematically over time they've come to realize that, look, once the election is over, most of the projection in terms of insecurity and in terms of violence does not really come to play. So that kind of like you know, gives a bit of confidence. So I do not see much of that changing this year. I feel that there will be, you know, exit, but then it won't be as much as people expect, because I feel that going into 2023, the expectation of foreign investors, you know, in terms of attractiveness of Nigerian market, will come to play. And I mean,